Hey, everybody. Welcome to our show, The Truth About Proof of Reserves and Stablecoins. My name is Board. I've been doing these spaces for a few months now with the team over at Stabull, who I've been advising and honestly acting as the token dumb guy who doesn't know anything about stablecoins and can ask the dumb questions that other people want to but won't on spaces. So I'm serving that purpose for you all. I've actually learned a lot working with the Stable team over the last few weeks and months, and I think the timing of our friendship and partnership is very well timed because obviously the stable coin market is getting quite large, and there is a lot of good regulation that is coming out that is making it an industry that is ripe for disrupting the financial markets, and I think something that is going to really be beneficial to both businesses and users of money, let's call them. So we've got a bunch of great guests today. I'm still trying to get Jeremy up here as well. So Jeremy, I sent you a request. Please do accept it if you see that. Oh, there we go. We fixed it. Awesome. Everyone's great. So usually the format of this show is we'll kind of start off and talk a bit about some of the headlines that happened over the last week or so as it relates to stablecoins, and then we'll get into a meatier subject, which in this episode is going to be what are proof of reserves? Why do they matter? Why is this something that applies to stablecoins and not other types of cryptocurrencies? So we'll dive into that. Before we get into the headlines, definitely would love to introduce and reintroduce folks who are going to be on stage today. By the way, I do see a few people requesting to come up. Sometimes at the end we do bring up people to kind of chime in and ask questions, but for now, just to keep the discussion flowing easily, we're gonna stick to kind of the prearranged speakers. But definitely appreciate everyone listening in, and if you want to chime in at the end and there's time, do request to come up. So we've got Jeremy now, we've got Andreas Lutz and Sebastian, who has been with us many times. I believe the Stabull account is being manned by Jason. Give me a thumbs up if that is true. Or maybe it's a mystery. Oh, it is. Okay, cool. So why don't we go ahead and start with introductions? Andreas, why don't you start off first, and then we'll go to Jeremy, and then over to Seb.
Yeah, sure. Hello, everyone. Nice to meet you. I'm Andreas, and I am the chairperson at the OFD. Now, to keep it short, OFD stands for Oracle Free Dollar. And as the name implies, it is a stablecoin that doesn't use and doesn't rely on price Oracle. I'll say more about that later on, but that's just an introduction.
It's an intriguing setup for sure, and I think it will be quite relevant to our discussion. Jeremy, over to you.
Hey everyone, nice to be on the space. My name's Jeremy. I'm a CPA by trade, and I'm a partner and one of the co-founders here at the network firm. We're a crypto native CPA firm, and we've been servicing stablecoin issuers and other institutions in the crypto economy since 2018.
Jeremy, quick side note. I had to go through about 5 CPAs before I found one that actually understands how to do my taxes. So I think you're a very high demand person probably right now.
Yes, bull markets bringing a lot of business and a lot of people asking questions. So yeah, feel free to hit us up.
Yep, for sure. And then Seb, representing Stabull, of course. For anyone who hasn't met you, would love to get a quick reintroduction, and maybe yourself and Jason could do a quick update on Stabull as well.
Yeah, thanks. It's great to be back. I've been working with Stabull since the beginning, really, on the product side. We are a AMM DEX for stablecoins, particularly local stablecoins, non-USD stablecoins, as well as RWAs. The kind of innovation or difference from other DEXs is that we use off-chain oracles for liquidity management and pricing. So that's in order to keep liquidity centered around the off-chain price of these stablecoins, and that's in an effort to increase capital efficiency and reduce slippage for traders. But yeah, we're really excited. This week we'll be launching on Base, a chain that has really supported and seen a lot of local stablecoins like BRZ and Canadian dollar stablecoin grow over the last few months. So yeah, we're really excited to be joining Base at a pretty busy time for the Base ecosystem.
Yeah, absolutely. I was actually at the base event last week and excited to see the growth in that particular ecosystem and glad to see you guys are going to be adopting base on Stabull.finance as well. So, yeah, before we get into kind of the main discussion point, three big stories worth touching on from the last 2 weeks. So, first of all, here in the United States, the Genius Act was quite a big story. It was signed into law less than a week ago on July 18th. Basically, it's one-to-one backing of digital dollars, so U.S. dollars. Will be backing USDC, USDT, other variations of that. Lots of very clear regulation, how it's going to be audited, disclosures, compliance. These are things that the crypto industry has been asking for a very long time, and now there's clear regulation. And also, obviously, a really big signal from one of the largest markets in the world that this is okay and we should grow it. Outside the U.S., in Shanghai, regulators met to conduct a basically a strategic response to stablecoins, and there's a lot of discussion around a yuan pegged stablecoin. So there's kind of an arms race now for stablecoins from large regions within around the world. And then on the bank side, basically a flurry of statements from bank CEOs about integration of stablecoins. So Citigroup is looking for a Citi stablecoin. Jamie Dimon, who famously, basically said Bitcoin and all cryptocurrency is a sham, is now saying they're trying to figure out a way to create bank accounts using stable coins. So it's a nice cope from Jamie. And then B of A, Bank of America, is also working on launching their own stable coin. And additionally, PNC Bank is now fully integrated with Coinbase. So, you know, it's interesting to see all the commentary and moves from banks to get into the stablecoin business, even though, ironically, some might say that it will actually end their reason to exist. Maybe that's a spicy statement, but we'll see how that plays out. I personally,
Yeah,
yeah, go
I
ahead,
think
Sam.
it's interesting to consider whether it is just commentary and like trying to mention stable coins in their earnings call. I think Jamie Dimon, probably we can always trust him to almost talk the truth, but it seems like their impetus is kind of almost fear of major fintechs kind of taking some of their business. He mentioned that fintechs, and probably Coinbase fits into that as well, as some of them are looking for bank charters. A lot of them, like Stripe, are doing merchant accounts for stable coins, and I think that's a large part of their why they're talking about stable coins and offering deposit-based stable coins, is because they don't want a large part of their business to be decayed to bigger fintechs.
Yeah, Jeremy or Andreas, would love to hear from you guys as well. If there's anything you've been watching in the news, or if these stories in particular, anything caught your eye.
Yeah, as it's specific to the
Honestly, I think it's
banker.
just
Go ahead, Andres.
please.
I mean, specific to the banking
Yeah,
side, I'm curious to see how things shake out because there's also been talk of tokenizing straight up the deposits that are at the banks. So I don't know how that actually is going to play out. But if you're going to tokenize a deposit, there's an opportunity to earn yield on those deposits. So this might be genius. The law that was passed doesn't cover tokenized deposits, but I can see them trying to finagle that in to create a differentiation between non-interest bearing stablecoins and these tokenized deposits that they're probably thinking about in the future. So I'm curious to see how it shakes out.
I agree. And I'm also kind of very curious to see whether we are going to keep that public interest even when we enter the next bear market, right? Because of course, institutional interest is quite a lot different from retail interest. But I guess we have all seen that during the last bear markets, we have also seen less going on from the institutional side, right? So is it all just kind of like following the current hype, or are there very serious intentions that will also be carried into the next boring phase? I'm going to call it, like not hype-based phase.
Yeah, I think the concept of tokenized deposits is like an interesting one, particularly for banks, and whether it's like a closed loop system. Can you take those tokenized deposits and really leave your bank and go to a non-custodial wallet and move it to maybe another bank? And I think parallel to that is there's been some discussion between the big banks of whether it's going to be more of a consortium model, similar to what they did with Zelle, if anyone's familiar with Zelle, like whether it's Citigroup, JP Morgan, and Bank of America offering one stablecoin or tokenized deposit between them.
Yeah, and I think the big question is, can they, with their volume scale relationships, offer better yield, right? Because that's the big question for me, is why do I keep my stable coins with a bank at all, other than maybe I'm just scared to self-custody it, or keep it in a DEX or whatever it might be. But for the the common person, for the average person who's looking to have a savings of a few $1,000s or whatever it um, is, do they need Bank of America? Do they need Citigroup to hold their digital dollars or whatever the currency is? And if so, is it going to be earning them a positive yield? Obviously, I think that those numbers, the yield will be probably more conservative to the overall market, because if you search around in crypto long enough, someone will offer you more yield, but it's always kind of a risk tolerance equation. But it will be interesting to see like what their edge will be to lure customers into banking with them when it comes to stablecoins.
I think some would argue that banks have like better access to yield. Like they have credit card, mortgage, business lending businesses, and long-standing businesses that have been around for hundreds of years. So, I mean, it's coming back to what Jeremy said. It's whether that can be rolled into a tokenized deposit within the current like regulatory frameworks.
Yeah, and in any case, I mean, it's certainly refreshing to go from a place where you pay a bank a monthly fee to allow them to hold your money, to they're now going to compete on how much they can yield for you. Like the idea of paying a fee now to a bank within the next 24 months does seem laughable to me. Tell me if I'm wrong. Push back if you think that's ridiculous. But given where things are going, that's kind of an insane idea.
Yeah,
Yeah,
definitely.
you're absolutely right. I mean, interest rates are going to decrease a little bit, but they're not going to turn negative like they sometimes do in Switzerland, for example. I don't see that happening in the US anytime soon.
Yeah, now makes sense. So, yeah, I mean, in terms of the news, really, really exciting, things happening. I think that the next 6 to 12 months is going to be is going to bring a lot of change in the banking industry. But let's talk about kind of the meat of today's show, which is proof of reserves. So, I think it's important to understand exactly what that means before we get into how to actually prove it. So, Jeremy, I think perhaps we can give you the honors to talk a little bit about what does that mean, and please do start off with like the layman in mind, right? Like if somebody never heard of this term proof of reserves before, like what's kind of like the elevator pitch on what that means and why it's important.
Yeah, sure. So the way I think of proof of reserves is that it's actually a reconciliation between an issuer, a stablecoin issuer, an exchange, an ETF, their liabilities that they've issued to their customers, are adequately backed by assets that the issuer is holding on that behalf. So maybe said another way is that, if you think about in the financial system, there's these layers. And each of these layers, there's areas of risk, right? Someone can cheat. So if you think about in an exchange example, let's say Coinbase. When you log into Coinbase, you see your account. It says you have 1 Bitcoin, you're doing pretty good. But how do you know the Bitcoin is actually there at Coinbase? I think we've been, you know, uh, lulled a little bit to sleep in just assuming that the fact that it says one Bitcoin on your account, it's actually there. But it might not be. Coinbase actually has to hold those assets on chain. So proof of reserves effectively is matching up those liabilities or that balance on your on that you see on the UI to the actually assets that they hold in custody. Now, if you expand this, because proof of reserve started with exchanges after Gox, Greg Maxwell, and a couple Bitcoin developers kind of ideated this approach, but that idea of proof of reserves has expanded to other use cases. So in the stablecoin use case, right, the liability in this example is the actual tokens issued and outstanding that you're holding or that have been minted, right? That's the liability. That's what the issuer is obliged to hold assets in reserve and redeem for the underlying if they ask for it. So if it's a dollar denominated stablecoin, your tokens, 1 USDC, there should be an equivalent of 1 USD or equivalents in the bank somewhere. So a proof of reserves in that context is making sure that they have enough dollars in the bank to cover all the stable coins issued and outstanding. That same concept can be applied in a bunch of different scenarios. I won't go through them all, but if you think about crypto ETFs, right, there's shares outstanding, they should be backed. I mean, the concept can even be applied to RWAs or even bridges and wrapped assets. So it's the core concept though is that there's this entity, there's this issuer, they issue liabilities or IOUs to redeem for the underlying. So proof of reserves make sure that there's enough assets in reserve to cover those liabilities that they've issued to token holders or ETF holders or exchange users.
Yep, makes sense. So, this is me just dumbing it down even more, but let's just say
Yeah.
there's a billion USDC circulating around. If tomorrow half the people who own it go and say, "Hey, I want to exchange that USDC for actual dollars that I can put in a bank account," those dollars better be there. They better be there to be ready to exchange. And there's a certain amount that needs to be held in proof of reserves, which I, from what I'm taking from what you're saying and my own understanding is, proof of reserves is a lot stricter with something like stable coins than it would be for other types of cryptocurrencies.
Yeah. I mean, your example is exactly right. Right. The proof of reserves process would basically be verifying that the assets in the bank are greater than the tokens issued and outstanding. So yeah, you can apply it to a bunch of different scenarios, right? In the crypto collateralized case, right, you might have a peso denominated stablecoin, and in reserve they might have Ethereum, they might have other assets, right? But the idea is that when someone comes to redeem, they're going to be able to get their money back.
And maybe this is a dumb question, but I'm going to ask it because that's my job. Is that almost like, is the current setup for stablecoins stricter than what it is for traditional banking? Meaning, I think in the past there have been situations where economies have had, quick little market crashes, things like that. A bunch of people essentially have, a UI, which is their bank account that says they have a certain amount of money in it, but then they go to the bank and they all want to withdraw at the same time, and the bank doesn't actually have the dollars because they're not necessarily required to hold a certain number of dollars because that's a very unusual situation. So, is it fair to say that banks have actually had more flexibility in proof of reserves than stable coins will have?
Yes, I would say that's 100% accurate. It's funny because proof of reserves is a crypto native concept, but it actually could be applied in TradFi, but I don't think they want to. Right? Your example of your bank account, right? You have, $5,000 and you deposit that cash into your bank. Well, they might take that 5 grand, they might lend it out, they might buy treasuries, they might buy a whole bunch of stuff. And if any of those underlying assets take a loss, right now your $5,000 account is under reserve. They might only have $4,000 worth of assets. And if you go and try to redeem, you're not going to get it all. Now, expand that by 1 million customers, and you can have a significant problem. So that's what happened like with SVB, and then where like last year when it actually USDC had some of their reserves there, everyone was freaking out as everyone would be able to get their money back. Ultimately, they were bailed out to an extent, but that's why we're in crypto anyway, right? Is that we don't think banks should get preferential treatment.
Yep.
Actually, if you don't
Go
mind
ahead, Brent.
me commenting on that. Yeah, so it's kind of funny, right? Because US banks, they need to have around 4.5 to like 10% capital ratio, right? Now imagine if you have a stable coin, know that the stablecoin issuer only has around 10% of that money. At all, right? Even though your US bank account can pretty much, if you deposit 5K, they can keep 500 as reserves, lend out 4.5K, and you would never even know it, right?
But that's like a cash capital requirement. Like yes, it's 4 to 5% in cash, like liquid to be redeemed almost immediately. But I think to Board's point, there is a concept of proof of reserves in the traditional finance sense. Like banks do get checked that they have some amount of cash on hand that can be redeemed. It's just in a fractional banking system, it's a lot less of a requirement than stable coins. And I did want to make, and Jeremy kind of already touched on this, I did want to make the distinction between all these different proof of reserves that we're talking about. There's the TradFi sense where both the assets and liabilities are off-chain. And then we have the centralized exchange, Bitcoin ETFs, even MicroStrategy, where the liabilities are off-chain, the shares or the units of the ETF or the representation in your Coinbase account, but the assets are on-chain, and that's where the reserves need to be proved. And then we come to fiat-backed stablecoins like USDC and USDT, where it's kind of the inverse of that case, where the assets are off-chain, the bank deposits, the US treasuries, and the liabilities are on-chain, the actual tokens. And then finally, we get to crypto collateralized stablecoins like Oracle Free Dollar and DAI, where both the assets and liabilities are on-chain. So that's kind of how I think of the different categories. I'm not sure if that makes it easier to understand for you, Board.
A little bit, yeah, a little bit. I mean, I always like to operate in kind of real world examples. Can you guys talk about maybe in the past, with other crypto reserves, what has happened when there has been a quote unquote bank run? Like, what has caused the downfall of certain tokens that were supposed to be backed, but then ended up, being liquidated and really harming a lot of consumers in crypto? You don't necessarily have to cite an example if you don't want to, but maybe you can talk a little bit about like what that situation looks like, why it has happened in the past and why it won't happen in the future.
Yeah, I mean the prime example is FTX, of course. So users were depositing assets on FTX, and what was FTX doing with that money, with those USDC, with that Bitcoin that was being deposited? Well, they were doing a whole bunch of sneaky things with it. They were making investments in other companies. They were leverage trading it. They were doing all sorts of things, and ultimately, when they were doing those activities, they didn't either have the liquidity or they hit losses on those activities. They were finagling with the assets. So when everyone came to, they heard that there was trouble and they came to redeem. FTX didn't have it, right? They didn't have the cash or the assets to fulfill those obligations, and we saw what happened with the downfall there.
Yep, makes sense.
I think the other example that comes up is like more recent. Well, not more recent, but Silicon Valley Bank. That was probably a more modern example of a bank run, which did actually affect USDC circle. But again, it's just they have a portion of their assets that are liquid. But if all depositors come along at the same time and ask for their money back, they don't have the liquid assets to redeem it all at the same time. A lot of their assets are held in like longer term treasuries or mortgages, and they take time to unwind. And often, if they have to do it immediately, it's at a loss. So that's where like the Silicon Valley Bank problem came about. Is a bank run is kind of a psychological thing. If everyone has this flight to safety at the same time, that's where a liquidity problem becomes like an actual problem. And I think that can be applied to fiat-backed stablecoins like USDC. If everyone was trying to redeem at the same time, they may have to sell some of their less liquid assets at a loss, and that's where they may have a problem, where reserves don't match their liabilities.
Yeah, had a fun situation with a startup a few years ago where we raised a few $1,000,000, had our money in Silvergate, and then 4 months after the raise, Silvergate went bye bye, and luckily we were able to pull all the money out quickly. But that's like a situation that just shouldn't exist anymore. If you're keeping your money in some form of dollar, specifically, there should never be a question of if the money will still be there tomorrow if you need it. That still is a challenge, but it shouldn't be in the next 24 months, I hope. And what you guys are talking about is implying that we're going to get there really quickly. So I mean, in terms of proof of reserves, we chose a very scandalous title here: "The Truth About Proof of Reserves." So what do you think is expected today in terms of stablecoin issuers and how they actually should go about both auditing and, I guess, being transparent and sharing that information, both with, I guess, regulators, but also like what do you think consumer expectations are going to be about that as well?
I guess it depends whether we are talking about a fiat-backed stablecoin or a crypto-backed stablecoin, right? A crypto-backed stablecoin, you can see the reserves on chain. That's the whole thing, and those should be pretty easily verifiable. But a fiat-backed stablecoin, that's a little bit more challenging because we all know the issues with USDT. People claiming that they do not actually have the required reserves because they wouldn't do certain audits, or then they would do audits, but maybe not of extremely reputable companies, right? And I think there lies the issue, because you can show an audit, but then the next question would be, who audits the auditor? Who guarantees that that auditor is actually legit and actually correct?
Yeah, I mean, and it's funny because I am one of those auditors, but it's once you introduce the assets that are off chain, that's where a potential point of failure can be, because now you're reliant on a third party to say that the information is true and accurate. Now, in the audit profession, we do have some oversight, right? If you audit public companies, or under Genius Act, if you audit big stable coins, you need to register with an organization called the PCAOB. It's effectively an arm of the SEC, and they'll come in and inspect you. There's also a peer review process, but it's not perfect, right? It's there still can be issues, and they're after the fact. So anytime there's anything off chain, right, it introduces this point where there could be issues, right, and they might not be found for a little bit.
So yeah, I mean, translation is, if you're using fiat currency, which is not a digital token, to back up digital tokens, uh, there's no blockchain to show that money, right? You're using the old system, and so it needs to be audited with people. And then I think to restate what was said earlier, who watches the watchman, and that needs to be a trusted party that doesn't work for the issuer. Um, and I guess, like, over time, hopefully, as things become more and more regulated and consistent, it's going to be more and more difficult for anyone to pull any funny business during those audits, and the money that is said to be there will be there. Um,
And Board, I was going to say that there's an interesting contention point too, because I mentioned like there's the layers to the system. Well, oftentimes there's stable coins, let's say they're partially backed by USDC. So now that stable coin has to trust USDC, and then USDC has to trust SVB, and then SVB has to trust their underlying counterparties that they're dealing with and the people that they've created loans for. So every layer introduces another potential risk of some problem happening. So unless everything's natively on chain, there's going to be these risk points, and there might be multiple of them the farther down you go in the layers.
this reminds me of mortgages from many years ago.
Yeah, and we know how that turned out.
From Stable's perspective, we've always wanted to have kind of a dashboard for all our listed stablecoins, where we could show attestations or proof of reserves. But unfortunately, it's kind of very it's hard to get those apart from linking to an issuer's website or showing a PDF of their monthly attestations. I guess my question for Jeremy is, do you think we'll eventually be at a stage where there's kind of a standard or a common API or some way to verify off-chain reserves kind of with an on-chain report? Maybe not real time, but at a bit higher frequency than monthly or quarterly.
Yeah, certainly. That's something that we've actually launched and worked on for years now, because we think, blockchains are real time. You know, we the world's getting faster, and it's funny that these reports are every 30 days, and you're not going to know of an issue until 30 days later. So we've developed a system we call real-time proof of reserves, where effectively what we can do is that if you have a technologically proficient auditor, you can hook in to the bank accounts effectively and read that data. You can develop code and logic and preconditions, and if those all pass, you can publish those via an API, or via a real-time kind of reporting dashboard. So we've done that. We actually just launched one with Bitwise, the ETF issuer, where we're verifying and looking at their underlying Bitcoin reserves on a daily basis, just due to timing of getting information from the underlying custodians. But yeah, I mean, I think that's the future of the assurance and transparency professions, is doing this more frequently and faster and more real time, so the data is more useful for investors and the public. We've also one other thing that I forgot to mention is that if once that auditor publishes that data from the bank accounts, right, that can be published on chain. So we actually have a partnership with Chainlink, where we can publish that data on chain for use in smart contracts. You can actually build in controls into the smart contract itself, where if the reserves are less than the token amount, it would actually halt minting. So I think there's a lot of interesting things that can happen once this data is available on chain. Of course, there's still a reliance on an oracle, so I think Andreas can point out some of the flaws there. But yeah, I think that's where things are going longer term.
Very cool. Yeah, we do use Chainlink for a lot of our oracles, and I had seen that they were offering a proof of reserve product, so it's good to see that that's already like in use.
I'd say there's 3 or 4 or 5 auditors globally right now that are doing it. So I suspect it'll once people realize the benefits, it'll be more widely promulgated. The problem is that most auditors aren't crypto in the first place and or technically proficient to be able to execute something like that.
This is wildly inaccurate, but I'm just going to picture in my head that there's people in a room that are taking dollar bills and putting them in a pile and counting them. That's not how that works, but I want to pretend it is. Andreas, perhaps a good segue though to the Oracle free dollar. So I'm sure for a lot of people listening that idea might be a new one. So can you talk a little bit about what inspired that? How exactly does that work, and how this could be a better alternative to the status quo?
Yeah, sure. So maybe you remember in I think 2019 or 2020 we had synthetics failure at Chainlink, and that enabled the bot to mint around $1 billion in fake Ethereum. That was rolled back later on, but it still showed the issue, right? At the end of the day, each price oracle is a single point of failure. You can build an amazing system, you can have everything done extremely well, but if the price feed is inaccurate, you are going to get liquidations in your system, for example, if you use it for that, or you are going to have wrong prices or just anything. It is very much an element pretty much in every single project nowadays, in every single ecosystem, but it is still a single point of failure. So around 2 years ago, a Swiss genius developed the Frankencoin, based not on Frankenstein's monster, but on the Swiss franc. And he eliminated oracles completely. Now that was, they had a very, very interesting test run. They are still active today with a market cap of around 30 million US dollars. So relatively small, but it works. And that inspired us to deploy the same kind of technology, the same kind of thing on the US dollar as well.
Got it. Yeah, no, makes sense. The branding is fantastic, despite it not actually being about Frankenstein. I think it'll be very viral and sticky. So appreciate that. So yeah, I mean, like just to kind of break that down a little bit more. Say there is a stable coin protocol or product that wants to leverage the Oracle free dollar, and more importantly, sell that to their potential users. Like, what's the quick elevator pitch, if that's possible? For the non sort of like banking crowd, like what does that even matter, I guess, to the average user, or if it doesn't, maybe why? But I'm curious if there's a way to sort of like frame that as an advantage for an issuer.
Yeah, so the protocol usually has like two approaches, right? One is if you have an hour time and you really want to go in deep. I know everything about the functionalities, etc. But to keep it very quick, OFD is especially permissionless, right? So anyone can mint new OFD by suggesting new collateral, which needs to be accepted by the current governance token holders. So not anyone can just mint OFD as they want, but anyone can suggest new collateral. So yeah, to keep it extremely short, one word: permissionless.
And just to add in some context of where an oracle comes in to a crypto collateralized stablecoin, like Oracle free dollar or DAI. These are often the reserves, or the collateral are Ethereum, Bitcoin, other stablecoins, and the problem becomes less of proving the reserves, because that's comparably easier on chain than off chain, as Jeremy mentioned, but it's more proving the value of the reserves, because when you've got a stablecoin pegged to a currency that isn't the collateral, it's a USD pegged stablecoin, not a Bitcoin pegged token. You have to, at some point when you're minting and also when you're liquidating that collateral, you have to say how much is Bitcoin worth compared to USD, or how much is Ethereum worth. So that's where the oracle comes in. For each collateral, you have to have an oracle to value how much of the reserves in comparison to the issued stable coins. And as Andreas mentioned, that can lead to some problems, not just when the oracle fails, but you have to have an oracle for each of the collateral. So it kind of limits what collateral you can use. So in the Oracle free dollar system, you don't have that limitation. So you can almost have a more diverse portfolio of collateral, because you're not limited by the need for an oracle.
Seb, is it fair to say that the banks and sort of larger institutional players who are going to get in this space are not going to participate in sort of non-dollar denominated stable coins? Like, is the idea of, you know, a stable coin being backed by Bitcoin and, you know, a few other kind of larger tokens kind of untouchable and too risky for any of these larger entities?
I'm not sure if it's untouchable, but I mean, we saw the Genius Act being passed. It's definitely not within the remit of that act. That was specifically for like fiat-backed stablecoins with a one-to-one backing, and I think they were even specific of what the backing had to be, cash or treasury bills. But I don't think it's out of the question for maybe non-bank institutions. I don't know. What do you
Yeah.
think, Andreas?
I was
Obviously,
gonna say actually,
I'm
Sorry.
speaking from a very US-centric perspective.
yeah, I can confirm. Yeah, like you would not be able to get licensed under Genius if you have like Bitcoin in your reserve basket. Like you said, it's like money market funds, short-term treasuries, cash, but it does include tokenized versions of those instruments. So like a tokenized money market fund or a tokenized treasury with a maturity less than 93 days could be in the basket.
Yeah, I mean, I suppose for at least, you know, the dollar, if the U.S. is passing these kind of regulations, they want the dollar to be the main currency. You know, it does help push the idea of dollar dominance, but also, I guess, just from a accounting standpoint and you know, making sure there's no risk to consumers. Even though we're in a bull market and everyone thinks, you know, Bitcoin is a way better backing to the dollar these days, that isn't always going to be true. And if you have these massive drops in price, it's not great when people want to go and withdraw their dollars and they can't get dollars in return. So can definitely understand that. Um, Jeremy, I wanted to just click back on one item when we were talking about you know, auditing and proof of reserves. Um, you know, what's realistic in terms of frequency of that process? Like, I can't imagine it's a quick exercise to do these audits, but at the same time, it probably needs to happen a lot because things can change, you know, day to day, literally. So, I mean, realistically, what do you think that might look like, say, a year from now or 2 years from now, as it relates to how often it needs to be done?
Yeah, so I'd like to make a distinction here at the outset because I think a lot of the community gets a little bit confused on this topic, like an audit versus an examination. And an audit is over the full company. So if you think about Tether, right, it would include Tether in the reserves, but it would also include your operations, your payroll, all these other characteristics that would be under the full company. So that's a financial statement audit. That's done annually, typically. Public companies get a quarterly review, but I don't expect that to be changing anytime soon over the full company. Just because it's on, those are pretty complex and they take a lot of time. Like some audits take 9 months or even the full year. Audits are going on effectively. However, the examination, that's what we see when we see those monthly proof of reserve statements on on websites of these issuers. Now that's a limited scope, right? That's just over the reserves and just over the tokens issued and outstanding. Now, if you limit the scope and that data is highly available, uh, like we've proven it, you can do that as frequently, as every 30 seconds, as long as the data is available from the banks and of course it's available from the blockchains. So I think eventually there's 4 or 5 auditors doing this today. I think as people see this more and more and the data becomes available, especially with Mika, now I think banks are going to be required to have APIs. Now that banking side that's traditionally been the slow side is going to be faster. You can do these proof of reserves, as as frequently as every 30 seconds, potentially. And I think 2 years down the road, 3 years down the road, uh, I think that's where it's going to land.
Yep. So basically, if something's going wrong, there's going to be triggers that go off very quickly to let everybody know, like, we need to course correct or, move your money fast. So, when we're talking about banks, obviously extremely centralized, USDC, Tether, centralized governance, auditing, all that. Andreas, maybe you can talk a little bit about decentralized governance. So, when the holders of the assets basically, are part of the solution or the management of stablecoins. Like, what does that look like? How can it be effective?
Yeah, sure. So the disadvantage of not having a price oracle is that somebody else needs to be able to do liquidations, right? If there's no oracle, liquidations are not going to happen automatically. And that is, of course, a type of risk. There is a very clear trade-off between not having an oracle and taking on slightly more risk. But in this case, OFD has to rely on its community and on its governance token holders, for example. Let's say like a position becomes under collateralized, that usually would trigger a liquidation in a traditional system that has the price oracle. The position would be closed, the collateral would be sold off, and the peg would be maintained. Now, in the case of OFD, at the point of minting new OFDs, there is a certain requirement to put in a certain amount into the actual reserve. And that reserve, of course, is going to cover losses that could occur in the system. Now, let's say you mint 1K worth of OFD and you put in 2K worth of collateral. Now, if your collateral value drops down towards 100% collateralization ratio, anyone can initiate liquidation of your position, but manually.
Got it. Makes sense. I think I know where you personally will be leaning.
Sorry?
Oh, sorry. I think there was a glitch in Spaces. Keep going.
Yeah. So yeah, exactly. In order to incentivize community participants and in order to incentivize liquidations, there is going to be a 2% award that is given to a successful challenger, right? But to keep it really short, of course, if you have no oracle, you need to have community involvement.
Yeah, makes sense. Which, I mean, candidly, in say DAOs has been challenging, at least ones that I've been participating in. Although in this particular case, in this type of decentralized governance, there's a lot at stake, and I think participation would probably be higher. But traditionally speaking, it's been a little bit of a challenge, and larger players sometimes tend to sway decisions or play a bigger role than everyone else in the community. Um, but yeah, hope to see that change. I did invite a guest on stage. Shameless plug, username. We don't want to do any shameless plugs, but did want to leave the last 10 minutes for open conversation. So appreciate you coming up and contributing to the conversation. Would love to hear your thoughts or question. Shameless, you there? No. All right. That's okay. Well, for everyone else, then our scheduled speakers, what other topics do we want to press into? Like, what other areas are you guys looking at as it relates to proof of reserves and stable coins that we should touch on a bit?
I think like a topical issue that's been in the news recently. It may not be as related to stable coins, but it's certainly related to proof of reserves. Is MicroStrategy. They've kind of been pushed a lot for their proof of reserves, which for everyone would. I mean, it's a lot more. It's perhaps more complex than this, but it's really like proving they own a wallet with a certain amount of Bitcoin in it. I'm wondering if you guys had any thoughts on should they and what are the kind of problems with providing that proof? Is there like security risks? I think Michael Saylor presented that as one of the reasons they didn't want to provide their proof of reserves. Yeah.
Yeah, I mean, my take on it is that I can sympathize with some of the elements of Saylor's arguments, and one of the big ones is privacy um, of your addresses. Right now, the whole world knows. Now, that's not necessarily a bad thing, right? If you're just sitting there and holding, but that means every time you move your Bitcoin, like let's say you want to sell, now the whole world knows if you're selling, or if you are sending it to a counterparty in that sale or moving custodians. Now the whole world knows and they can track that Bitcoin forever. So I get that part, the privacy consideration. Um, and hand in hand, I guess, with privacy can downstream come security components of that. So I know in our talks with ETF issuers, they've been moving from publishing their addresses as they started small and wanted to build trust with the community to actually moving to other forms of transparency to reduce showing their full address list. And part of it was they're going to have hundreds, thousands, or millions of addresses. So it's kind of hard to verify all those unless you're technically competent. You have the tools to do that. Um, and
Or,
what's just an easier way to digest?
perhaps for like a custodian, could it be that one address has a mix of different like issuers' assets?
Yeah. So for most of the ETFs, my understanding or what we've seen in the field is typically they have dedicated wallets for
Right.
the most part, but that could be possible, right? The underlying institution could commingle assets, and then you couldn't even publish the addresses because it wouldn't be accurate. It wouldn't be one to with a specific ETF, for example. So that's certainly a consideration.
And what are some of the like other ways? I think you mentioned Bitwise before, to prove reserves on chain without like providing addresses.
So I'm most familiar with what we do, obviously. So effectively, what we do is we act as an intermediary between the addresses published on chain and the public. So what we do is we look at the balances ourselves on chain using our audit system, effectively, or our attestation system, and then we can summarize and consolidate the balances that we see at all the addresses that we ingest, and then we can publish just that number of Bitcoin from all the addresses at once, right? Without disclosing the addresses. Of course, it introduces another centralized party, us in this case, but in the world of trade offs, this is the route that they determine they'd like to go.
I mean, I still trust Michael Saylor, but I did move most of my my stocks from strategy to IBIT because I don't know, BlackRock doesn't f around. But hey, whoever is continuing to work with Michael, I salute you, and I think he's doing a pretty good job overall. Um, all right. We've got 3 minutes left. I think we've covered a lot of ground. I appreciate you guys helping increase my understanding of proof of reserves by 10%, which is a big move. Glad to have you here, and glad to have everyone who listened in live, and of course who will listen to this in the future as a recording. Before we duck out, I do want to just kind of give everybody on stage a chance to send people into a particular direction, plug something, ask people to follow you. So, Andreas, why don't we start with you, and then Jeremy, and then Seb, you can close things out.
Yeah, gladly. So at the Oracle $3, we are on a very, very interesting journey, right? Eliminating oracles. It is for sure going to be very interesting to see whether that's going to be the next standard for stablecoins. So if you want to stay up to date, you can just follow OFD_BNB on Twitter. And yeah, it would be great to see you over there.
Excellent. Yeah, and if you're looking for transparency measures using kind of the traditional CPA method, but using a crypto native team, feel free to reach out to me. You can follow me on Twitter, or you can go to thenetworkfirm.com.
You're doing good work, Jeremy. Thank you for that. Seb, how about yourself and Stabull? What should people be doing right now that maybe they aren't?
Yeah. for Stabull. Look out for our launch in the next day or so on Base. We'll have a number of new stablecoins that you can buy on Stabull and become a liquidity provider in our pools for, where you can earn a sustainable yield. But yeah, definitely glad to be on today. We do have the Oracle Free Dollar and Frankencoin recently launched on the Polygon side of the DEX. So if you're interested in buying those and learning more about those stable coins, then go to stable.finance. We're on Twitter at stablefinance, one word. And yeah, hope to see and talk soon.
Very good. Appreciate you, sir. Amazing. Thanks, everybody, for another great episode. I think we're on like episode 6 or 7. We'll be back in either a week or two. We'll share timing very soon, but have an exciting lineup coming up and lots of news to share. So appreciate everyone again for listening in, learning a bit more about stable coins and where they're going. And we'll be back soon. Take care.